So European ETF trading, I mean, first of all, if to have trading, you've got to have some assets. So if we could take a look at European ETF asset under management, that would be very good. Or not, okay. So basically, the problem with Europe, here we go. So the US has been a lot bigger, as everyone knows, but Europe is smaller in terms of assets under management in ETFs to a bizarre extent. And we've got two asset managers with us on the stage today. Carmen, perhaps you could sort of, I know we've spoken about this before, about why it might be that Europe is so much smaller in terms of AUM than the States.
When we discussed it before, I already made the point that I sometimes feel that it is an unfair comparison to put European ETFs versus US ETFs and to expect for it to grow in a similar way. Europe is far more fragmented than the US is, and also in terms of regulatory developments and from an advisory perspective, sort of wealth management perspective. But I think in general, from a trading culture perspective, is at a very different place than Europe is. In Europe, it's slowly coming in, but from an investor perspective, when there still needs to be quite a lot of education of what an ETF is, we seem to have a much stronger mutual fund culture as well in a lot of the countries that we look at. And then when it comes to the trading, this deep liquidity that you seem to see in the US, it's so much more elusive to see in Europe because you can trade on various exchanges, and very often you don't see, especially with the OTC flow, which historically has been around 70–80%, you don't necessarily see it. So I think there are a number of issues that I would summarize as education, culture, trading culture, and fragmentation probably being the most important one, as one of the reasons why the development has been slow.
Yeah, okay. Christopher, you work for Europe's largest ETF trader, Flow Traders. Your company's founders set the business up in 2004, just as ETFs were getting going over here. I guess it's always been a puzzle for your execs why it hasn't really taken off in Europe to the same extent. Would you agree with Carmen that it's to do with culture or there's structural problems as well?
Yes, I do agree with what Carmen says, and obviously there are some structural problems too. I think she touched on fragmentation being one. Compare the US to Europe, you would have one single market in the US, one depot in which all your ETFs are located, in which you all settle these. Compared to Europe, you're talking about 6 major exchanges at least, and some peripheral exchanges. You have as many depots, if not more, in which you can hold your ETFs. So to have to manage all that inventory across all those different exchanges, and then being able to provide prices on all those different exchanges, so memberships across all of them, it's just an extra step, an extra hurdle. Now, the way that ETFs have been adopted in Europe, I think, is also quite interesting to highlight, is that if you look at what happened on stateside, is that we're looking at least a good chunk of the volumes that we see on the US stock exchanges are generated by retail trading ETFs. So 401ks, etc., have adopted ETFs in their investment horizon, and these ETFs are traded by retail on a daily basis. I'm not going to put any numbers on it, what the split is between institutional and retail, but let's say there's more retail traded volume in the US than there is institutional. And in Europe, it's actually been the complete opposite, where you have had the launch of ETFs have been adopted by institutional investors out there, and it seems that we're struggling a little bit to get retail on board. Is that to do with regulation? Has that to do with education? Has that to do with marketing? But slightly but surely, we seem to start to get some retail attention. So that's
okay.
Good.
Keshava, I mean, you're joining us from DWS. You're both a fund manager and an issuer. So actually, you've probably got like a good perspective of why you see this difference between Europe and the US. Is it partly to do with the role of advisors on the continent?
I think it's definitely a key factor. I think I agree with what Carmen and Christopher also said. The retail market, if you look at the US, they're very much about I work hard and I make my money work hard as well. In Europe, until recently, it's been I'll work hard, but let my money relax in fixed deposits or money market instruments. And fixed income is a big angle where people have been using. And the advisors also, the regulation, as kind of Carmen briefly touched on has been very different. You look at the Reg NMS requirement, post-trade transparency requirement in the US, kind of looking at the NBBO, National Best Bid Offer, where you have to send the orders to different exchanges. That's resulted in a very big transparent market. And also the advisors, the RIAs, have been really kind of looking at using ETFs, whereas in Europe, there's been a kind of a trader fee or retrocession model that's been kind of in place. The UK was one of the first ones, the RDR, that came through Retail Distribution Review. And we've seen huge change in some of the retail platforms and the aggregators. I think we're on the right step. And we are seeing the increase in AUM by those advisors and those aggregators and the platform. So if you look at some of the bigger platforms in EMEA, now we're actually actively being called by them to say, we need to put ETFs on our platforms. Please come through, have a discussion. Whereas 5 years ago, we could make all the phone calls and they'd be like, what's your trailer fee? Can you pay me 1%? Our TR is 30 basis points. We can't really pay 1% trailer fee. So things are changing. And even from a retail perspective, the millennials, and I was on Tube a couple of days ago where I saw an Extracker ETF by a fellow passenger trading on his phone app. So things are changing. So I feel very good. And if you look at a couple of our exchange numbers that are coming through, exchange volume is also increasing to show that we're on the right path. And with MiFID II and some of the other regulations, I think we'll definitely increase. And new clients have come in place from that advisory angle as well.
Okay. I've never seen someone buy an ETF on the train personally. Maybe I'm on the wrong line. Andrew, would you say that European money is a little bit lazier than in the States? And are things getting better, as Keshava seems to be saying?
Yeah, I tend to obviously agree with my colleagues here in terms of the retail penetration that's going to happen slowly in Europe over time, with things like regulation driving that, MiFID II, making ETFs more attractive to advisors to use them in their portfolios, is certainly going to do that. I mean, in the US, we've just seen the zero fee mutual fund, which is obviously going to be attractive, and I don't think it's long before we see the free ETF come to market, probably in the course of the next year. And I think new asset managers are going to come into this space. We've seen it in Europe with groups like Fidelity, Franklin Templeton, JP Morgan. I think that's going to help because they have existing distribution of selling their mutual funds into these retail advisory channels. That's just going to help the message and grow the overall market share for the existing issuers as well. So there's a combination of sort of regulation, new issuers that's going to drive that. And naturally, with that going towards that US trading model of more retail volume going onto the exchange, that natural liquidity is going to help the institutional side because you're then going to get into a world of, it's very much OTC trading at the moment. There'll be things like algorithmic trading, better price discovery, and it's going to sort of fulfill that institutional piece as well. So the two go very, very hand in hand. Okay.
I mean, here, even in the UK, pre-RDR, which is what, 5 years ago? Yeah, I can actually remember you could try to buy an ETF, but you were still paying your advisor like the same amount as you would for like a standard index fund, which was just a crazy setup. Are those days now behind us, Carmen?
I would say that it's definitely, the landscape is definitely evolving and it is changing. I think in particular here in the UK, RDR has had a massive impact on investor behavior. Clearly the proliferation of platforms and the fact that ETFs are not available for trading on those platforms means that index funds have had an explosive growth within in particular the retail population. But I still think the availability of ETFs has increased. One shouldn't forget the impact. We talk about regulation, but also the impact that fintech is having on the usage of ETFs. Because while it might not be directly the retail investor who buys an ETF through their app, as Keshava was telling us, it could very well be that they have their account through a robo-advisor in some other form, and that robo-advisor might offer a fund that then, or something, an account that then invests in various ETFs. And this is where we see quite a lot of growth coming in the industry. And this is what we believe is going to contribute to ETFs growing quite substantially. And when you see it in your account, you might also at some point want to buy it individually and so on. Fintech has helped the access and helped get it out there much more.
I mean, there's another big thing this year which hopefully is helping with ETF adoption in Europe, and that's been MiFID II.
Yes.
Yesterday, one of the speakers said that MiFID II was all about investor protection, which I've always rolled my eyes whenever I hear that, because it's kind of MiFID II is whatever you want it to be. And in the case of ETFs, one thing that it has done is make a lot of trades that were taking place off exchange that were previously invisible. It's made them visible. And Christopher, obviously I'm going to come to you because your firm is a massive fan of off-exchange ETF venues. Has it made the world a better place? And how come, if you look at this chart, you see that volumes, although they did peak earlier in the year, it's come down a bit in the last few months. It hasn't been unrequited good news for ETFs.
I would beg to differ slightly, because obviously we had January, February with some volatility spikes all over the market. So, and ETFs are very often used for strategical allocations, and sometimes people would have some core changes. So that's why Jan and Feb were obviously really good. And then we obviously have at the end of summer, which is always slightly slower, let's put it that way. Now, what we've seen with MiFID II, and we hope to see even more, is that, to put it in really simple English, is that you had on-exchange trading, you had off-exchange trading. When off-exchange trading happened, that would have been me or my colleagues in the market making markets on a Bloomberg chat or on a phone to somebody. That trade would happen here, there and then, and that would basically disappear in the no man's land. There would be hardly any reporting of that trade. You would not find it on any form of regulated ticker somewhere or on an exchange. Now, the evolution that we had 2 or 3 years back when RFQ, request for quote tools, came into the market, that got completely electronified or electronized, the way you want to put it. So that stream is now done fully electronically through a request for quote platform, but right up until I think it's November or December, those platforms were still considered fully OTC. Now with the switch over into MiFID II, those platforms had applied, most of them had applied to become an MTF, which is obviously what MiFID II intended, is to make sure that when these trades actually happen, they happen on an MTF. Therefore, that MTF will be reporting the trade, and you will see those trades. Hence, clearly, what you see now is that when you look at and I'm not going to touch on the lack of a consolidated tape for now, but the fact that if you know where to look for it, and it's not that hard, you could literally see what's going around in the ETF market without too much of a problem. And we're hoping, obviously, that somebody, or soon or rather than later, comes up with a more consolidated form. We could look at Bloomberg maybe, to kind of put that up there for us so that we can actually see all those venues, so all the little MTFs on the side, the regulated markets, and the potential SIs who are trading these ETFs, that we can put them all into one nice little reported venue. But yeah, you clearly see that there is a big chunk of OTC trading happening. It's being done by most of the institutional investors. We are obviously a fan of both OTC and off-exchange, because we represent easily a quarter of the on-exchange trading too. So for us, wherever it goes, we'll always try to be there.
Okay. Well, OTC trading has actually been bigger every month since May, which is kind of impressive considering that we're not even capturing all of it yet, because there's a third ETF RFQ platform, RFQ Hub, which is yet to report its trades. Andrew, are you aware of other sort of like missing ETF trades under MiFID? Because Brown Brothers Harriman, you do a lot of the settlement, the back office stuff, where you can actually work out from that what's going on.
No, I mean, it's. I think it's sort of building a bit on the subtle point that you made at the OTC trading that's now being reported is still driven from those institutions, and it's still going to the RFQ platform, receiving multiple price quotes, but it's still a risk price in terms of going to those 4 or 5 brokers such as flow traders, and executing at that point. What we need, back to the point before, is in terms of retail coming into market, driving more on exchange and making that on exchange flow more competitive, so that then price discovery and the actual trading on the exchange of the ETF becomes more aligned with the actual NAV of the fund. So I think I haven't really seen unreported from our position as the as a custodian, but certainly I think anything that's going to drive more liquidity onto the exchange is ultimately going to give a better outcome for the investors, because it makes the pricing more tight and competitive.
If you want to put the US into this, I think if you're going to take the proportion of OTC trading that actually happens in Europe, and you're going to add on the liquidity or the trading done by retail in the US, in Europe, the same volume, same proportions, you'll actually have way more on-exchange trading versus OTC.
Yeah.
Because regardless of a misconception, a lot of people think there is no OTC in the US. There is a hell of a lot of OTC trading happening in the US. I think we could probably put it around 25 to 30%. The difference is that it gets reported to the tape, so you can literally see what happened. But we still get pinged in the States too, right? Like, can you make as a market in 10, 15, 20, 30 million? And that does not go through the exchange.
I think I'd like to hear from the two fund managers now, because after all, you have to get the prices from the likes of Flow Traders, Strange Street, and I don't know if anyone from Susquehanna is here. It's the other major ETF trader. MiFID II, you can, as you see from the chart, you can actually now see where most of those OTC trades are taking place. Are you getting a better result now, Keshava? Start with you.
Absolutely. I think, if you look at until the first week of June, when we made a big announcement, we had a record year, in Europe. I think back of basically clients now embracing ETFs because they could see the full volume. We had clients who were not using ETFs before because it was below a certain threshold, or they could only use a percentage of the visible volume. And we've seen new clients come and use ETFs, but also existing clients using in bigger sizes because there's bigger volume available. To Chris's point before, there is definitely more volume being visible, but there's still some missing. So the good thing is that there's no more this kind of big portion of OTC anymore, because everything is either exchange or kind of MTF. There's a very small portion, a few venues that are very small missing, but it becomes more visible, and issuers like us and others are basically making a lot of effort highlighting to our clients, showing that full volume. I mean, we see the charts like this, and that's adding a lot of confidence to clients. When we used to say before, only 30% of the trading visible, they took our comment for as a golden source. Now you could see, volumes have more than doubled, and depending on volatility, as Chris mentioned earlier in the year, there's a bit more volatility. And this goes back to the previous conversation in one of the panels where they said, when crisis hits, actually people use more ETFs because it becomes the choice of, better choice of tool, and market makers across the floor and across the street really are there to provide multiple avenues to do that. So both our internal clients, but external clients, we've seen a significant increase. And we also have data available, with the help of some of the vendors like Bloomberg and others, trying to get that information out there to be really, the products are very transparent. They're structured very transparent. The market structure didn't allow it to have full transparent data. Now we have that as well, thanks.
Okay. And Carmen.
Yeah, I would like to touch on the point that you made. While I share your optimism that things have clearly improved, I think there's still a long way for it to fully improve, because I think we as a provider still have to tap into various sources to get a full picture of where the liquidity is, and we might miss out a source here or there. And we referred to, Chris earlier mentioned the consolidated tape. For us, this is a necessity. And we can put the data together and disseminate it to our clients as best as possible. But we might not be able to touch all the clients. Someone might look at one of our the ETFs that we obviously hope to be very transparent and not have this access to all this data flow. So what a consolidated tape would be is to sort of create a level playing field for everybody, and in particular for investors who don't have to rely always on the provider to get a full picture of data. So, I would also put the point to Bloomberg. Clearly this is up for grabs at the moment, and it's something that the industry needs to continue growing. I think it's an important point in the transparency of ETFs, which has improved, but definitely we're not there where we think we should be.
Okay. I think we've heard from both of yourselves as buy-siders. I think now I'd like to invite the audience as well to see what they think. Let's have a polling question. Thanks to MiFID II, I can now see how often European ETFs trade and where. I'm getting a better deal when I trade as a result. Who agrees and who disagrees, please? Hopefully it'll be up in a minute.
Maybe something to add. Quite interestingly, if you want to compare again the US to all this, this is actually a point where we are ahead of the US. Electronic trading, RFQs, access to real liquidity providers, all those kind of things is actually one of the steps that they are starting just now in the States to look at requests for quote.
Okay. I can ask you what you think about these numbers, but I'm quite surprised. I thought it would be exactly the opposite way around. Keshava, why do you think that's more people are finding it harder?
I think it comes down to, it probably will be the numbers would have changed from last year. I mean, obviously, are we at the perfect place? As Carmen mentioned, it will come a long way, more advisors using, there's more transparency. But there are still 18 APAs, and there are different trade reporting facilities. It's still fragmented reporting, right? So it's not one golden source you can go to. I know Bloomberg, we mentioned Bloomberg a couple of times, but they're working on changing the description page to show a full volume across all of them. I mean, you're kind of best placed. So I think if you look at this, it's hard to compare now, but if you did this last year, I think that disagree would be even much higher. Yeah. So now you're seeing agreed is much more higher as well. So what I would basically say that, whenever we can get Bloomberg to kind of go through on the description page, I know we're getting a lot of emphasis on Bloomberg, but I think the numbers will improve. And again, just to kind of summarize that, things have come a long way, but are we there at the perfect place? But there's no consolidated even for single stocks yet, right? Yeah. So we're going to get there.
Okay, can we, let's just move on. Obviously, there were two things going on at the moment. One's MiFID II that the industry has to contend with, and the other is Brexit. At least with MiFID II, we knew how long it was when it was coming into effect. With Brexit, we know when it's coming into effect. We know there's going to be thousands of pages of documents from regulators. The FCA put out 1,000 pages yesterday. But no one at this point has any idea what will actually happen. Let's assume, because this is kind of a more instructive exercise, if there is a no deal, what does it mean for how European ETFs are trading?
So I mean, I think just it's not a problem that's completely acute to the ETF industry. It's obviously impacting on the asset management industry more broadly in a few different areas. I mean, ultimately, there's a huge amount of uncertainty. It's going to will create greater fragmentation, which is ultimately going to drive up cost as well, potentially, because ETFs very much rely on their ability to passport via a UCITS product from Ireland, and obviously part of that is into the UK market. So to continue to over time serve those UK clients, we've certainly had conversations with a number of issuers of actually looking at setting up ETF platforms specifically for that UK market over time. There's a couple of other issues, and I think maybe Keshava and the guys are a better place to talk to it, but around again, with these being Irish securities, their eligibility into CREST from a sort of settlement perspective, and then also cross-listing products again back into the UK. So there's all these sort of additional layers of complexity where there's uncertainty at the moment, and we're waiting to see how that plays out. But it's obviously going to sort of add cost potentially.
Carmen, at HSBC, is this at all near the top of your list of priorities at the moment?
Well, of course, it's very much on the top of the list of priorities. The uncertainty that we have at the moment also means that you always have to assume that the worst case scenario is going to happen, so that you're going to be prepared. And we look at it from two layers. I think one layer is very clearly the UK investor and how this is going to affect our UK clients and the UK infrastructure, and the rest, the second layer then is the European one. These are obviously Irish securities, so they fall within the EU framework. So any touch points that these securities have within the UK, we need to find an alternative for that. So CREST obviously is one of them, and the LSE is another one. So these are the type of issues we need to look at. But for us as a provider, obviously the thing that we are most concerned about is the investors. Can they continue investing into these products? What alternatives do we need to offer them? Are the same routes of distribution still available, and so on and so forth?
Okay. Keshava, you're an issuer. You were telling me earlier that a lot of your ETFs are domiciled in Luxembourg. As you can see from the chart, the UK is teeny tiny issuer of, domiciler of ETFs. So, Brexit, what's it going to do to your business?
Is that the time? I think it's clearly it's on high on our agenda. We're looking at various scenarios, and one thing that Andrew mentioned about the CSD angle is definitely an angle that people are considering. Whether even Irish securities can settle post. If there is a hard Brexit. Luxembourg domicile funds as of now, we don't see any issues there. We are one of the largest issuers there, domiciled in Luxembourg. But we also have Irish domicile funds, that's fast growing. So it's an active dialogue that we're having with regulators, but also industry participants to look at, how do we kind of provide a solution and make sure. And yesterday's paper, and again, I haven't gone through all the 1,000 pages yet, but they're saying there's a 3-month consultation paper. And looking at maybe like a 2 or 3 year extension of as it is. So we're looking at all available angles to see what's the best thing for our clients.
Okay, Christopher, you're about to open regulatory approval pending. You're about to have an office in London for Flow Traders, which is currently just in Amsterdam in the EU.
Yeah. So basically, the way that we look at it is that. Obviously, we're a little bit more nimble than these very big asset managers next to me. Quite humble sitting here. But that means that whatever is needed, basically, we will do. So that could come to the point that we would have full representation in the UK with fully operational trading facilities here. Basically, if that is what it takes. And I think my peers who are based here have all come to the lovely Amsterdam. So we're gonna basically own the Amsterdam-London route. It's gonna be beautiful. So flights between Amsterdam and Southend and City Airport do very well out of Brexit. Or the train nowadays, Eurostar, by the way. But it's for us basically it's something that's in our nature to adopt, to change, and to whatever comes at us, we will just make sure that business is as usual to the people that work with us.
Let's finish with the second polling question, if we may, please. What does the audience think the outlook is for European ETFs post-Brexit? Fragmentation, chaos, decline, or sunlit uplands? Your choice.
There we go.
Okay. So, that's more Brexiteers than I would have expected in this room. All right.
I mean, that's in already a fragmented market that we have today. To see that is quite a worry.